In this video, you will learn about taxpayer audits conducted by the Internal Revenue Service, or IRS. An IRS audit is a review of an individual's or business's financial accounts and information to ensure that the information reported is accurate and complies with tax laws. During an audit, the IRS examines various financial records to verify that the correct amount of tax was reported and paid. While audits can seem intimidating, they are a part of the IRS's compliance process to maintain the integrity of the tax system, ensuring that taxpayers pay their fair share based on their true financial situation. The individual conducting the audit is an IRS auditor or agent. These professionals are trained in tax law and specialize in ensuring compliance. Depending on the complexity and nature of the case, IRS agents may work alone or as part of a team. There are three main types of audits that taxpayers may encounter. 1. Correspondence audit. This is the simplest form of audit and involves the IRS sending a letter requesting additional information or clarification about a specific item on a return. Taxpayers generally respond by mail. 2. Office audit. This type of audit is conducted at an IRS office. Taxpayers are asked to bring documentation for a more detailed review of their financial records. 3. Field audit. This is the most comprehensive type of audit, during which an IRS auditor visits the taxpayer's home, business, or representative's office to examine records in person. The auditor's role is to assess the submitted documentation and any other relevant financial information to determine if the tax return is accurate and complete. Several factors can trigger an IRS audit. Here are the most common reasons why a tax return might be selected for review. 1. High or unusual deductions. Claiming unusually large or excessive deductions compared to income can raise a red flag with the IRS. Examples include high charitable contributions or substantial business expenses. 2. Discrepancies or inaccurate information. If the information reported on a tax return does not match third-party data the IRS receives, such as W-2 forms, 1099 forms, or other records, it may lead to an audit. Underreporting income that appears on third-party forms will almost always attract the IRS's attention. 3. Cash-based businesses. Taxpayers who operate in industries with large cash transactions, such as restaurants or retail stores, are often scrutinized more closely, as these businesses are considered higher risk for underreporting income. 4. Self-employment income. Self-employed individuals may have a higher risk of being audited because they can claim business expenses that may appear questionable. Deducting a home office, travel expenses, or meals without proper substantiation can trigger an audit. 5. Earned income tax credit claims. The Earned Income Tax Credit, or EITC, provides benefits to lower-income taxpayers, but is frequently subject to abuse. As a result, tax returns claiming this credit are often closely reviewed. 6. Foreign accounts and assets. Failing to properly report foreign income, assets, or accounts may prompt an audit. The IRS has specific regulations governing foreign assets, and compliance is strictly monitored. 7. Random selection. Some tax returns are chosen for audit based solely on statistical formulas and computer algorithms designed to flag returns as potentially non-compliant. This system, called the IRS's Discriminant Information Function, assigns a score to returns. Higher scores may indicate the need for further review. 8. Losses from businesses. Reporting consistent losses on a business could trigger scrutiny from the IRS, particularly if it appears that the business is being used to offset personal income without evidence of a profit-making intention. 9. Unreported income. Not reporting all sources of income, such as earnings from freelance work, side jobs, or investment gains, can significantly increase the likelihood of an audit. 10. Complex returns. Returns with multiple forms and schedules are inherently more complex and present more opportunities for errors or questionable deductions. This complexity can make them more likely to be selected for an audit. It is important to note that an audit does not automatically indicate that a mistake was made by the taxpayer or their tax preparer. The IRS conducts audits for various reasons, many of which may be beyond the control of the tax preparer. Here is why an audit does not necessarily imply an error or wrongdoing. First, random audits and compliance checks. Some audits occur purely by chance or based on statistical formulas. This means that even highly accurate and meticulously prepared returns can be selected for review as part of routine compliance efforts. Second, IRS misunderstandings or data errors. Sometimes audits occur because of a misunderstanding or due to inaccurate data received by the IRS. For instance, third-party documents such as 1099 forms may contain errors that result in discrepancies in reported income. Third, complex or unusual transactions. The tax code is complex and open to different interpretations. Reporting a complex transaction could trigger an audit even if everything was correctly reported. The audit allows the IRS to better understand the transaction and verify the correct tax treatment was applied. Fourth, focus on high-risk areas. Certain deductions or credits, like the EITC, are more frequently abused, leading to more audits in these areas. Even a legitimate claim might undergo scrutiny to ensure compliance with IRS guidelines. Finally, support for taxpayers. During an audit, taxpayers have the right to representation. This means they can involve their tax preparer, accountant, or attorney to help navigate the audit process. Tax preparers often act as advocates, ensuring that all communication with the IRS is handled professionally and that any questions or concerns are fully addressed. To conclude, while an IRS audit can be stressful, it is often just part of the agency's due diligence process and does not imply guilt, fraud, or even a mistake by the taxpayer or tax preparer. Taxpayers can minimize their chances of being audited by filing accurate returns, keeping detailed records, and working with knowledgeable tax professionals. In the event of an audit, being well organized and prepared to present supporting documentation is key to a successful resolution.